anchor currency. And we've got it at whatever the fixed exchange rate is. So this is a way of trying to create credibility to the commitment that the fixed exchange rate will remain fixed for a very long period of time. Okay, now probably the most predominant fixed exchange rate today is the Hong Kong dollar versus the US dollar. So you can see that beginning in about 1984, the Hong Kong dollar has been fixed to the US dollar at approximately 7.75 or 7.76 Hong Kong dollars to the US dollar. Now it's not absolutely flat, but boy, that is pretty flat. That's only fluctuates by a couple of Hong Kong pennies every now and then. So that's probably the longest fixed exchange rate that I'm aware of in existence today. Now, when we fix an exchange rate, the rate at which it is fixed is called the official rate, or the fixed rate, or the par rate, or the pegged rate. Remember the reason we have multiple terms for exactly the same thing is to confuse people who haven't taken the class. Maybe even to confuse people who are taking the class. Okay, but fixed, pegged, par, official rate, all can be used interchangeably. I will generally use fixed rate, because that's just the way I'm fixed in my thinking that way. Okay. Now, that official or fixed rate may or may not be the same as what we call the fundamental rate. Right? The fundamental rate is the rate that is established by supply and demand. It's what the exchange rate would be if it were a floating exchange rate, right? Intersection of supply and demand. So you can peg or fix the exchange rate at its fundamental value, but remember the fundamental value of an exchange rate changes with supply condition or demand conditions, right? Domestic interest rates, foreign interest rates, expected future exchange rates. So the fundamental value can bounce around. Again, the official rate, the fixed value, is fixed. You can end up magically at the fundamental rate, but you might be over it or you might be under it. So let's consider the situation where you might be over it. So what we call an overvalued currency. Now, we're using overvalued here differently than we did on Tuesday when we talked about purchasing power parity. Right? This overvalued simply means that the fixed rate, which we call E par, is greater than the fundamental rate, or equilibrium rate, E star. So, if we were fixing the US dollar, we would say, let's fix this up here. So this would be E par. This would be our fixed rate. And this down here, E star, would be our fundamental rate. So you can see right away we fixed it above or over its fundamental value. That's what we mean by overvalued. Now, that obviously, that fixed exchange rate is not an equilibrium. So something has to happen, right? We can't stay in disequilibrium forever. So something's going to happen. The government and the central bank of the fixing country then have three choices. They can devalue the currency, they can impose capital controls, or they can intervene in the foreign exchange market in order to make this happen. Okay? So let's look at each of those real quickly. So the easiest out for the government might be to simply devalue the currency, reduce its fixed exchange rate. Right? So we'll end up then devaluing the currency, moving it from that official rate down to the fixed rate. So what would happen here is the official rate would then be dropped to match the fundamental rate, which means that E par now is moved down to E star. So we've devalued the currency. You don't actually have to go right to the fundamental rate, but that gets you if you're close, then other things will happen. Good things will happen. So we've got an exchange rate now that's no longer overvalued. Now, the difficulty in doing this is remembering that over time, that fundamental value is going to change. Supply and demand conditions, real interest rates here and abroad, expected future interest rates are going to affect that demand curve. And if you're going to devalue all the time, trying to catch up with it, why don't you just float your exchange rate? So the idea behind fixed exchange rate isn't to be devaluing it all the time. It's to fix it and leave it there for a long time. So that means with devaluation, while it's a possible solution, isn't really a very good solution. Now, the second thing that the government can do is to impose capital controls. So what capital controls do is to prevent foreigners from actually buying some of your domestic currency assets. Right? So if we thought about all the dollar-denominated assets in the country, and now we say, oh, by the way, if you're not an American, you cannot own real estate in this country. Period, end of story. That's it. Oh, by the way, maybe we won't let you own stocks in our large companies, or we won't let you own bonds or other types of assets. Right? So basically what we're doing is removing some of our dollar-denominated assets. So the supply curve for dollar-denominated assets declines, and what would happen then, the equilibrium value would move up to its par value. So the fundamental rate now matches the official rate. So imposing capital controls is the only time that we will shift the supply curve. Or using capital controls, I should say. Okay. Again, you run into the same problem that you had before. The fundamental value is going to continue to change over time. So you would have problems with managing this. By the way, this is one of the ways, though, that China manages its currency, is by having capital controls on. So you limit both the amount of foreigners wanting your assets, and you also limit domestic residents from taking their assets or acquiring foreign assets. The third way, and by far and away the most usual way, is the central bank simply intervenes in the foreign exchange market. Remember, the way that central banks can do this is by buying and selling their currency to maintain that fixed exchange rate. Now, what we have to remember here is that when a currency is overvalued, what would the central bank need to do in order to increase the demand for the currency? Sell it. Okay, but think more fundamentally, not with the currency. What is it that needs to happen? Remember, there are three things that determine exchange rates: domestic interest rates, foreign interest rates, expected future exchange rate. If I want to increase the demand for my currency, what do I need to do? Offer a higher return. How about raise the domestic interest rate? Right? Central banks know how to do that. They do that with monetary policy all the time. So somehow the central bank needs to intervene in a way where it will be raising the domestic real interest rate. It does that by buying its own domestic currency. So by buying its own domestic currency, it's taking currency out of circulation in the economy, which will reduce the money supply. Causes the monetary policy curve to shift up. Higher real interest rate at every inflation rate causes the aggregate demand curve to shift to the left. Now, when it buys its own currency, it has to offer something in exchange. What it sells, then, is foreign currency-denominated assets, what we refer to as international or foreign exchange reserves. All central banks have them. So if you remember our central bank balance sheet that we looked at before, we had government securities, we had discount loans. We kind of stopped there because that's all we wanted to talk about at the time. But central banks have other assets, too. Many central banks, for instance, have gold on their balance sheet as an asset. And almost every central bank balance sheet that I've looked at, has foreign currency-denominated assets. Typically government securities issued by foreign governments in their own currency, that is, in the foreign government's own currency. So if you looked at the balance sheet of the Federal Reserve, you would see they own Japanese government bonds, they own German government bonds, British government bonds, Canadian government bonds. Last time I looked, they didn't own any Chinese government bonds, but a whole bunch of stuff. Right? So all of those bonds, though, were denominated in the currencies of the governments that issued them. Okay? That's what they would end up selling, offering in exchange. As I mentioned, when you buy your own currency, your domestic money supply declines, your domestic real interest rate goes up. That causes the demand for the currency also to increase. So what we've done is we've shifted the demand curve out. This would raise the fundamental value, and the exchange rate would appreciate. The fundamental value would increase so that we bring it up to the fixed exchange rate or its par value. Now keep in mind, when the government does this, they are losing international reserves. So they've got a loss of international reserves. And this raises an interesting issue about overvalued currencies. How long can a central bank maintain an overvalued exchange rate? And the answer is only as long as it has international reserves to sell. Once it runs out of international reserves, it can't make that foreign exchange market intervention anymore. Right? You can only sell what you've got. Once you're out, the game's up. Then you need to do something else. You can do capital controls, you can devalue your currency, or you can stop fixing it and simply let it depreciate. Right? It's not a devaluation. They wouldn't be moving to a lower fixed rate. They would allow it to depreciate. So this whole notion of losing international reserves can become quite an issue. And in fact, if investors speculators think that a country is losing international reserves and is going to abandon its fixed exchange rate, it can lead to a speculative run. So what investors/speculators would do is to borrow in the domestic currency, the fixed currency, immediately sell it at the fixed exchange rate, move back into dollars, wait for the depreciation to come. Once the depreciation comes, you take your dollars and you buy back in and you get, because the currency is now depreciated, a lot more of those foreign currencies. Now you pay off your debt. Right? Borrow the domestic currency, change it to the anchor currency, wait for the depreciation, take the anchor currency, go back into the domestic currency, pay off your debt, you got a whole bunch left over. This worked so well in 1997 that my bonus at a financial institution paid for my older daughter's 4 years of college. So this has happened time and time again. Countries that try to maintain overvalued currencies, by the way, almost nobody does anymore because of this experience, that if you try to maintain an overvalued currency, you're likely to run across speculators who are going to bet on a devaluation or a depreciation. This was the genesis of the 1997-1998 Asian economic crisis. Thailand, at the beginning of the crisis, had approximately $45 billion in foreign exchange reserves. 6 weeks later, they were down to something like $10 billion. Do that trend, right? 45 to 10 in 6 weeks. How long does it take to go from 10 to 0? Not very long. So everybody piled in. So notice what actually happens. When everybody piles in, the demand curve from the private sector pushes way back this way. In order to maintain the fixed exchange rate, the loss of reserves just gets bigger and bigger and bigger. So just bet against the central bank. If you win big. And that's what happened in Thailand. And then once Thailand's fixed exchange rate blew up, everybody looked around the world and said, who has an overvalued currency with limited foreign exchange reserves? Let's see, Malaysia, Indonesia, South Korea, Israel, Russia, Brazil, went global. Okay, there's the Thai baht. So notice that for 10 years, almost 10 years, the Thai baht was pretty fixed. It wasn't a declared fixed exchange rate. And at the beginning of this time period, it wasn't even overvalued. In fact, it was undervalued. But over time, the fundamental rate changed, and it became an overvalued currency. When they almost ran out of reserves, they decided not to spend their last $10 billion, by the way. They just let it go. And you can see that you could borrow 25 to 1 before the crisis. After the crisis, you would get back 50 to 1. It was hard not to make money in those days betting against the Bank of Thailand. Now, there are all sorts of real problems also with fixed exchange rate that the Thai situation brings to bear. When you have a fixed exchange rate, or something that looks fixed for a very long period of time, the general attitude of people is that it's going to stay fixed, right? Why is there any reason for it to change? So one of the things that we saw is that the Thai government, in many Thai corporations, including Thai banks, rather than borrow in Thai baht, their domestic currency, they actually borrowed in US dollars. and they would borrow in U.S. dollars to fund activities inside Thailand. So think about what the situation is. The government had tax revenues, and the corporations and the banks had revenues in Thai baht. But their liabilities were in U.S. dollars. Think about what happens to Thai businesses when all of a sudden you realize, oh, I borrowed at $1. It used to cost me 25 Thai baht. Oops, now to make the same dollar payment, it cost me 50 Thai baht. Now all of a sudden the cost of your liabilities has doubled. Guess how many Thai businesses survived that? The ones with big dollar liabilities, almost none of them. The Thai government had to go to the International Monetary Fund, the World Bank, the U.S., the OECD to borrow money for bailout. Not the first time we've had this happen. Many Thai corporations went bankrupt. Many Thai banks went bankrupt. Really, really bad situation. Huge, huge recession. And notice what else happens. After the economy stabilizes, took about 2 years, by the way, for it to stabilize, notice what happens. Huge depreciation of the currency. What do you think happened to net exports? Went up. They went up a lot. In fact, they boomed after that. So there was a really bad period of time in the late 1990s where many East and Southeast Asian countries got caught up in something that looked like this, went into deep recessions, and then their export base started to explode. And that's what pulled them out of recession. So notice then that this depreciation, especially these big depreciations, have a bad side, but they also have a good side too. But I can assure you, you don't want to live through something like that. Okay, so now let's think about the other side of this. Let's think about the situation where the fixed exchange rate, or the par value, is below its equilibrium rate. Right? So now we've got something that's undervalued, under its fundamental value. So a lot of this is just, as you might expect, the opposite of what we've just done. We've now set the fixed value, or fixed rate, below its fundamental value. So it looks something like that. Again, this is a disequilibrium situation. So we have to figure out how we deal with it. 3 things we can do. Sounds very similar. 1, we can revalue the currency. 2, we can relax capital controls. Or 3, we can intervene in the foreign exchange market. So this is basically just the opposite of what we talk about for an overvalued currency. So here, rather than devalue, we call them revaluations. So we've revalued from one fixed rate to a higher fixed rate. We don't actually see revaluations very often, but it does happen. And typically this would happen, as you might expect, because a country no longer wants to acquire international reserves, which we'll see in just a minute. Okay, so the official rate then just simply says, okay, we're not going to maintain the old official rate. We're now going to redefine the official rate to be something close to its fundamental rate. Again, I want to emphasize, I know I sound like a broken record here, fundamental rates don't stay the same. Thailand started with an undervalued currency in the late 1980s and early 1990s. It was the fundamental rate that changed to move it to an overvalued currency. Government could relax capital controls. So rather than impose them, let's relax them. So the supply that's made available to investors is now greater. This will cause the fundamental rate to fall to the official rate, and now we're no longer undervalued. And then the most interesting case is what happens when we do foreign exchange market intervention. So when a currency is undervalued, what we need to do, right, is reduce the demand for the currency. So in order to reduce the demand for the currency, we need to have lower domestic interest rates. So in order to have lower domestic interest rates, we need to have a bigger money supply. So the central bank needs to sell its domestic currency, which will put more domestic currency in circulation. It will be acquiring foreign currency-denominated assets. So if you've ever wondered, where did that overvalued country get the international assets to intervene with in the first place? At some point, they probably had an undervalued currency. So again, this is just the opposite kind of transaction that we were looking at before. Notice that these foreign exchange interventions are very similar to open market operations. Very similar to open market operations. Remember, if the central bank wanted to reduce the domestic interest rate for purely domestic reasons, it would do an open market purchase of government securities. The central bank would acquire the government securities. It would pay for it by increasing the domestic money supply. That would cause the interest rate to go down. It's really no different here, except that the intervention is not in the domestic government securities market. The intervention is in the foreign exchange market. We're trying to adjust the relative quantity of domestic currency versus foreign currency in that market. Okay? So the domestic money supply increases. The